Welcome back to the ICT or SMC Beginners course. Today is Fair Value Gaps Part 3. We're going to be going over when a fair value gap has failed, when it is failing, and ultimately where you should be placing your stop loss so you can take minimal loss on a losing trade and ultimately make sure that you're in all of those winning trades as long as that fair value gap is holding and is essentially, by definition, still valid. We're also going to be going over my personal risk management and trading parameters when it comes to fair value gaps. So if that's something that interests you, make sure to stick around. So to properly understand where to place a stop loss on a fair value gap, we first have to look at when a fair value gap is failing and ultimately what we want to see the fair value gap do. And most of the time, I like to see an institutional order flow entry drill, and the short term for that is IOFED. And essentially what that means is price is never going to trade to consequent encroachment. So that includes this wick here. As long as we're above this 50% line right here, CE or consequent encroachment as it's properly called, or the term for it, we are still bullish and we can expect in this case a strong price movement to the upside. The same goes for here. As long as we don't trade above this dashed blue line or consequent encroachment, we can expect a relatively strong push back down off of this fair value gap. So now that you understand what we ideally want to see, let's first talk about when a fair value gap has officially failed. And what that looks like is that means we have a body close below the low of this fair value gap. So if it's a bullish fair value gap or a BISI, ideally this would tell us that this fair value gap is invalidated and this is a failed fair value gap. That does mean that this is technically still a successful fair value gap. This wick is allowed to go anywhere that it pleases as long as the body closes in the fair value gap or above the fair value gap. This is still a valid fair value gap and price is still respecting bullish order flow in this example here. Same thing goes to the bearish example here. If price has a massive wick like this all the way to the upside, doesn't matter where it goes, it can go way up here. This is still a valid fair value gap. This is still a valid fair value gap. This here is still a valid fair value gap. This is now a failed fair value gap. And this wick can be here as well, but as soon as we get a close above candle 1's low, this is now an invalid fair value gap and potentially could even inverse into an inverted fair value gap or IFVG, but we will get into that in later videos. So now that you understand what a fair value gap looks like when it has officially failed, let's get into risk management and how I like to place my stop loss when we're talking about fair value gaps. So if we take a look at the buy side imbalance, sell side inefficiency, or BISI over here example, and I'm going to take my entry right at the beginning of this fair value gap, the safest stop loss placement for this trade is going to be below the swing low. This is your safest stop loss placement, but ultimately it's going to offer you the most risk. So this is something that you have to keep in mind. So it's the most risk in terms of handles or points, but it's always going to be the least risky when it comes to staying in the trade, because the trade can do something like this and keep you in it, whereas other fair value gap stop loss placements will ultimately take you out of the trade. So with that being said, let's hop into the second placement or location for a fair value gap stop loss, and that's going to be below candle 1's low. So this is going to be your middle ground. This is your somewhat risky in terms of handles. As you can see, we took a lot of risk off the table in terms of handles or points. We're at 28 compared to 40 like we were here, but ultimately price could still come down and stop us out and then move in our direction. So this is still a possibility with this trade setup or this fair value gap stop loss, whereas this one is less likely to have that happen. And ultimately, the most risky but still valid stop loss placement is going to be below candle 2's low. So as long as we are below this candle 2's low, this is still a valid stop loss placement, and this is going to offer you the least amount of risk in terms of points and handles, which ultimately will result in a higher risk to reward than the other two stop loss placements. But what that means is you are more likely to get stopped out on a wick, because like I said, a candle can do something like this and still be a valid fair value gap. So you have to make your own decisions as to where the safest stop loss placement is, given the volatility and ultimately where price is going to go. In this example here, we can see we have another fair value gap down here, so it might be best to have your stop loss below this fair value gap's low, as in this is candle 1, this becomes candle 2, and this becomes candle 3 in our 3-candle fair value gap formation. So if you were to take this fair value gap here and ignore premium and discount rules, this would be a safer stop loss than going below candle 2's low and ultimately trusting that this fair value gap is going to catch us. And in this example, you could see you would be stopped out and then price would essentially continue in your direction after stopping you out. So now let's go over the bearish example here, and I'm going to add my own risk parameters so you can get a better idea as to what I would actually look like if we were to trade this fair value gap example here. So you know by now probably that I like to take my trade entry at the very beginning of the fair value gap, and essentially what that means is my lowest stop loss in a bearish example is going to be above candlestick 2's high. This is where I would ideally like to see my entry. And I'm not really interested in putting my stop loss anywhere below this wick. This is going to be the most safe given my risk parameters, which are going to be 15 handles. So as you can see in this example here, I have a risk parameter or my stop loss limit of 16.75 handles, and that's simply too much for me. So I'm either going to move my risk up a little bit or I'm going to move my entry up into this fair value gap a little bit more so I can ultimately have my stop loss above this high and within 15 handles, or I'm going to hop into a lower time frame and essentially look for lower time frame market structure to confirm bearish price action and try and get in a trade somewhere in here where I can then allow a 15 handle stop loss that is more safe given lower time frame structure. But the general rule of thumb for me is if I cannot get 15 handle stop loss out of this room right here from the entry of the fair value gap to candlestick 2's high, I either need to move my stop loss into a deeper point of the fair value gap, my entry into a deeper point of the fair value gap, or I need to go on a lower time frame and look for a lower time frame entry model. Generally speaking, this tends to be on a 15-minute time frame or higher. Within a 5-minute time frame, I can most of the time get away with this entry point within the fair value gap and a stop loss above candlestick 2's high or below candlestick 2's low in a bullish example. But if I can't, I'm going lower in time frames and I'm finding a better entry opportunity. If possible, I would like to put my stop loss above candlestick 1's high. If there's any way for me to get into a trade and have a 15 handle stop loss, and this is not 15 handles, but if there was and have my stop loss above candlestick 1's high, this is a great stop loss placement. And the final and most safe stop loss placement is going to be above the swing high here, and that essentially allows price to continue in a bearish trend, if that's what we're doing, and ultimately continue to make lower highs. So as long as we make a lower high, you would still be in the trade. Even if it comes all the way up here, if your stop loss is above the last swing high, you have the safest stop loss placement possible, while still understanding that once we get a close above this fair value gap, it's probably best to close out the trade and ultimately take a smaller loss than when price comes all the way back up here. Now that is a more advanced way of trading, so if you are brand new to trading and specifically trading fair value gaps, it's probably best to let price come all the way up to your fair value gap, your stop loss, because there might be other fair value gaps in price, like over in this example that we saw here, and there's also going to be order blocks and things like that that can catch your trade even though you don't know or recognize what these things are yet. So if you do know those things and you're an advanced trader, recognize that once this occurs, it might be best to stop out your trade at a significantly smaller loss. However, if you're brand new, please wait for your stop loss to be hit or your take profit to be hit, because that's how you're going to learn to trade with probabilities and ultimately make the best trading decisions you possibly can. So the last thing that I want to clarify before going into the real charts and taking a look at these fair value gaps is essentially when I take an entry and I say that my max stop loss is 15 handles, this is in reference to the NASDAQ chart or NQ futures chart. If I was to be trading ES or the S&P 500 futures chart, my max stop loss is going to be 5 handles, which you can see is going to be represented here, but it's going to look very similar in terms of distance on a chart, and that's just because of the difference in price between the NASDAQ and the ES or S&P 500 futures is going to be about 1 to 3. It's not perfect, but essentially these are my risk parameters, is 5 handles on ES and 15 handles on NQ, and if I can't get those, I'm either not taking the trade or I'm going on a lower time frame to confirm that market structure and price action is going in my direction, and then I'm looking for a lower time frame entry where I can have a 15 handle stop loss on NQ or a 5 handle stop loss on ES. So now that that's hopefully clear, let's go into the real charts and take a look at some fair value gaps there. So taking a look at some real candlesticks here, let's go ahead and dive into this example that I showed you on the market structure shift video. This is going to give you some insight as to how I would have internalized these fair value gaps and ultimately picked the best entry for my specific trading style. So if we were to look at this big fair value gap, and keep in mind, we are on the 15-minute time frame, and I said if we're on the 15-minute time frame, generally I'm going to be looking at lower time frames for entry models. And this is a good example here. Would I have taken this trade here? No, because to have the safest or the least safe stop loss is going to be above this candle's high. This is candle 2's high. Candle 1, candle 2, candle 3 in a fair value gap formation, and this is way too large for me. And to have a stop loss anywhere in here at 15 handles, would it have worked? Sure, it would have worked and you would have been in the trade still, but this is not a safe place to have a stop loss, so this is not a logical trade for me to have taken. So instead, I would have gone down to the 5-minute time frame, and as you can see, we have some fair value gaps in here too. So after we would have shifted structure on the 5-minute right here, which is what we talked about before, high, low, higher, high, lower, low, shifting market structure, back bearish, we come back into this fair value gap here. Would I, with my personal risk parameters, have taken this trade here if the least safe stop loss but most logical stop loss is above candlestick 2's high, candlestick 1, 2, and 3 to create this premium fair value gap? This is not logical to me because there is a 25 handle stop loss required just to get the least safe entry or stop loss placement on this trade. So what am I going to do? I'm going to hop down on another lower time frame, and in this case down to the 1-minute time frame where I can actually execute on, and I can see after this 5-minute shift in structure, we come back into the 5-minute fair value gap, which is this box here, and we ultimately shift structure on the 1-minute back in line with these higher time frames to be bearish at this candle close right here. So this candle determines that bearish price action on the 1-minute is going to continue here, and therefore we see that we have this fair value gap right here. This is the only fair value gap that is created in this leg, so it's okay to take this at a discounted price. We're going to take our entry at the very beginning of this candlestick right here, or the very beginning of this fair value gap, which is how I like to take all of my entries, which would mean that we're filled on this candle right here. We can then see that the least safe stop loss placement, but most logical, is going to be above candlestick 2, which is this candlestick right here. As you can see, price does not come above this candlestick's high, so this would have been a winning trade even with that stop loss placement, and I could have placed my take profit at the low of day right here, and that would have been a very nice trade opportunity. However, I would have looked at this and I would have said, okay, this is still too tight of a stop loss placement for me. Even though the risk to reward is great, this isn't a very high probability chance of me not getting stopped out. Price could be volatile here and take out this high, and I don't want to be missing this trade opportunity. So I can put my stop loss above candlestick 1 here, which is that middle ground in terms of risk, still giving me a good risk to reward, and I still am within my 15 handle stop loss range, so this is a valid trade idea. And lastly, if I go all the way above the swing high here, this is now 15 handles. This is the safest place for me to put my stop loss, and it's within my risk parameters, so this would have been the trade that I personally would have taken with my stop loss way up here. Lowers my risk to reward, but gives me the best opportunity to win this trade in the long run. So this would have been the trade opportunity that fits my personal risk parameters and ultimately fits the basics of ICT's price action, fair value gaps, and market structure shift concepts. So this could have been your entry here, and you would have been able to capitalize on this move and much more realistically as price continues to sell off later throughout the week here. So I know we briefly discussed and talked about potentially stopping yourself out when the fair value gap fails here, but for me personally, there was lots of other pieces of confluence and trading confluence in here that would have wanted me to stay in this trade even if this fair value gap failed, like this order block right here, this order block up here. This is actually a propulsion block, but this order block, this propulsion block, and ultimately this swing high that rejected this 5-minute fair value gap here. So this was a trade that I would have been willing to hold all the way up to my stop loss up here, because at the end of the day, my entire trade idea was not based off of this fair value gap. This was just my entry technique or the place that I wanted to enter the trade on. So if we take a look at this example here on Monday of this week, we can see that we have this market structure shift right here. So at this 3-minute candle, we're on the 3-minute time frame at 11:18 in the morning. We actually shifted structure. As you can see, we had a close above this high. with some displacement that essentially gave us this fair value gap here. Now, with my risk parameters, I'm allowed to take this fair value gap at the entry of this trade or at the entry of this fair value gap if my stop loss can be 15 handles or less and below candlestick 2. Remember, this is candlestick 1, 2, and 3 of the candlestick formation. Candlestick 2 is low. We're at 12.75, and this is a valid trade for me. However, I'm still going to drop it down to 15 handles just because I want to be able to have that little bit of extra room if we do get a massive wick into this order block here. Now, we do have relative equal highs up here that we would have wanted to target, but all I was looking for on this trade was to capture 50% of the retracement, so I actually got out right at this 0.5 level here for about a 3.3 to 1 risk to reward trade. As you can see, price comes into this fair value gap, taps into the top half of it, does not reach consequent encroachment or 50%, and ultimately gives us that institutional order flow entry drill that we were talking about before price continues to shoot up quite rapidly and fast up to these highs, and ultimately we end up taking out those highs in the PM session. But this was the trade that I was looking for and the only trade that I took on that day. So I hope this kind of starts to make sense now and what you're looking for. When you do have that fair value gap, you need to have your stop loss at least below this candle's low, if possible, below this candle's low. But for me in this example, we didn't have the risk parameters to take this low here, so this was totally okay for me, and this was a valid setup and ultimately a safe one and a less risky trade, given the fact that my stop loss can be below this low here. So I hope this is kind of making sense now and you find some insight and usefulness in this. If you do have any questions, make sure to let me know in the comment section down below and I will do my best to answer those. And until next time.